Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because what happened between 4:50 p.m. and 6:15 p.m. BST today is not a routine on-chain movement. In under 90 minutes, 19.8 million XRP was pulled from Korean and European exchange order books and routed directly into Tier 1 institutional custody vaults. That single transfer pushed the multi-day supply vacuum past 195 million XRP against the backdrop of exchange liquid supply sitting at a 14-month low. But here's the number that changes the entire frame of this analysis. Institutional OTC desks are currently tracking a 12% liquidity premium, meaning smart money is paying 12% above the public exchange price just to secure volume without disturbing the visible order books. Stay with this analysis until the end because there is a specific mathematical floor of $4.62 that a leaked London fintech white paper has calculated as the minimum XRP price required to handle projected institutional corridor volume without causing liquidity fractures. And the exact calculation behind that number will reframe everything about what the Monday New York Open means for this market. Let us establish the analytical baseline that this entire evening's data sits inside. Because the psychological pressure that retail holders are experiencing right now is the direct product of a misread market signal. When exchange prices consolidate and public order books show limited movement, the retail interpretation is that demand has paused. That interpretation is precisely what institutional accumulation programs are designed to produce. The 12% OTC premium is the clearest available evidence that demand has not paused. It has migrated. Smart money has moved its purchasing activity off public exchange venues where large buy orders would immediately compress the ask side and create visible price movement, and onto private OTC desks where transactions are negotiated bilaterally and settled directly into custody without appearing in public order flow. The 12% premium is the price of invisibility. Institutions are paying above market to accumulate without signaling, and the premium itself is the signal that retail is not reading. The behavioral pattern that produced tonight's 19.8 million XRP transfer between 4:50 and 6:15 p.m. BST is not spontaneous. It is the continuation of a systematic accumulation program that has been running across multiple time zones and multiple exchange venues for several days. The total multi-day supply vacuum now exceeds 195 million XRP. To put that number in structural context, 195 million tokens removed from public exchange liquidity represents a supply compression event of a magnitude that has no equivalent in XRP's recent trading history, occurring at a moment when institutional demand channels are simultaneously expanding through ETF products, OTC desks, and direct custody transfers. The three accumulation channels are operating in parallel. ETF creation is absorbing supply through regulated US fund structures. OTC desks are absorbing supply through private bilateral transactions, and direct custody transfers are absorbing supply through automated institutional programs executing outside of public market hours. The supply is being removed from three directions simultaneously. Matt Hougan's public statement as Bitwise CIO deserves precise analytical attention because what he communicated on the record is not a casual endorsement. Hougan stated that demand for a spot XRP ETF is substantial, and the SEC has formally acknowledged a spot XRP ETF application. In the context of the current regulatory environment, formal SEC acknowledgement of an ETF application represents the initiation of a defined review process with statutory timelines. Institutions that are building XRP positions today are not speculating on whether the ETF will be approved. They are front-running the approval process itself, accumulating the underlying asset at current prices before the ETF approval triggers the next wave of institutional inflow that a regulated fund structure delivers. The Bitwise demand signal and the SEC acknowledgement are not two separate data points. They are the beginning and middle of a sequence institutional capital flow event whose end, the Monday opening with 195 million tokens already removed from available supply, is being set up in real time. The Federal Reserve dimension of tonight's analysis is the data point that most XRP market commentary is systematically failing to integrate into the institutional thesis. Ripple personnel, specifically James Sellich and Ryan Zagone, are officially named inside a Federal Reserve document relating to the Faster Payments Task Force and sit on the Faster Payments Council. This is not a peripheral advisory relationship. This is confirmed operational involvement in the Federal Reserve bodies that are designing the architecture of the next generation of U.S. payment infrastructure. The institutions that are moving 19.8 million XRP into custody vaults tonight are not making speculative bets on an unproven technology. They are positioning into an asset whose underlying network infrastructure is being co-designed by Ripple personnel sitting inside the Federal Reserve's own payment modernization working groups. That is a different category of institutional conviction than ETF demand alone produces. The privacy architecture that David Schwartz confirmed in a private developer chat at 6:40 p.m. BST tonight provides the technical bridge between the Federal Reserve's payment modernization requirements and the XRPL's institutional deployment readiness. Schwartz confirmed that the first institutional sidechain is currently in its final audit phase. The architecture functions as follows. Banks operate private, compliance-ready ledgers that handle the travel rule requirements and confidential transaction metadata that regulated financial institutions are legally required to manage. Those private ledgers settle instantly onto the public XRP ledger using XRP as the bridge asset while keeping the specific transaction details within the permissioned layer. This architecture simultaneously satisfies the privacy requirements that have kept U.S. banks under NDAs and the public settlement infrastructure that the Federal Reserve's faster payments mandate requires. The sidechain is not a future development. It is in final audit. The gap between final audit and production deployment is measured in weeks, not quarters. The OKX RLUSD integration represents a capital flow development whose structural significance extends well beyond the headline announcement. OKX has taken RLUSD live as institutional margin collateral across 280 trading pairs. Margin collateral is not a retail product. It is the mechanism by which institutional traders secure leveraged positions across large portfolio exposures. When RLUSD functions as margin collateral on 280 trading pairs at one of the world's largest exchange venues, every institutional trader managing a leveraged book on OKX now has a direct operational reason to hold RLUSD and, by extensions, to interact with the XRP ledger infrastructure that RLUSD is built on. The demand for RLUSD as margin collateral is a structural demand driver that operates independently of price sentiment. Institutions need collateral to trade. RLUSD provides that collateral, and every RLUSD transaction on the XRP ledger generates fee demand for XRP as the settlement asset. The Ripple Treasury System's active deployment among U.S. corporate CFOs adds an institutional demand dimension that sits entirely outside of the speculative capital flow that most market analysis focuses on. Corporate treasury operations are not investment portfolios. They are the cash management infrastructure of operating businesses, the systems through which companies manage their working capital, their cross-border payment obligations, their foreign currency exposure. When U.S. corporate CFOs are actively using Ripple's treasury infrastructure to manage fiat and RLUSD flows, the XRP ledger is being integrated into the operational financial architecture of U.S. corporations. That integration creates recurring, transaction-driven XRP demand that is structurally independent of market sentiment. It does not increase when retail is bullish and decrease when retail is bearish. It increases proportionally with the transaction volume of the corporations using the infrastructure, and corporate transaction volume is driven by business activity, not by crypto market cycles. The Treasury Collateralization surplus growing past the 105% floor creates a self-reinforcing liquidity mechanism that institutional desks are now modeling as a permanent backstop rather than a temporary surplus. At Ripple's current RLUSD issuance level, the 105% collateralization requirement generates weekly interest income on the U.S. Treasury instruments held as backing. That surplus, now exceeding the 105% threshold, is being deployed into liquidity provision programs that maintain deep XRP and RLUSD order books across institutional trading venues. The compounding effect is structural. More RLUSD issuance generates more surplus funds, more liquidity provision. Deeper liquidity attracts more institutional transaction volume. More volume generates more RLUSD demand, and more demand drives more issuance. The mechanism does not require a price catalyst to sustain itself. It sustains itself through the volume of institutional transactions flowing through the infrastructure it is designed to support. The ecosystem confirmation from tonight's data arrives through the convergence of three independent institutional signals: the OKX RLUSD margin integration, the Ripple Treasury System CFO adoption, and the Federal Reserve Faster Payments Council participation, all occurring simultaneously with the supply compression event. This convergence is not coincidental timing. It is the product of a deployment sequence that has been in progress for an extended period, reaching multiple operational milestones in the same window. Because the underlying regulatory and technical preparation work that each milestone required was being conducted in parallel. The institutional sidechain entering final audit, the RLUSD margin collateral going live on 280 pairs, and Ripple personnel sitting inside Federal Reserve payment modernization, working groups, 3 outputs of the same long-duration institutional integration program reaching its visible deployment phase simultaneously. The Monday New York market open now carries a specific structural risk for the retail investor who is not positioned before it. Exchange liquid supply is at a 14-month low. 195 million XRP has been removed from available public supply across multiple days. OTC desks are paying a 12% premium above exchange price to secure volume without disturbing visible order flow. Spot ETF demand is confirmed as substantial by the Bitwise CIO on the public record, and the SEC has formally acknowledged the ETF application that will trigger the next wave of institutional fund inflows when approved. The condition this creates for Monday's open is what analysts are describing as an air gap, a supply structure so compressed relative to incoming demand that the price discovery mechanism cannot move linearly. When buy-side demand re-enters the market with a 14-month supply low and a 195 million token vacuum, the order book does not absorb that demand at current prices. It moves through the available ask inventory at accelerating velocity until it finds genuine resting supply at significantly higher price levels. The $4.62 floor calculation that closes this analysis is not a community price target or a social media prediction. It is the output of a leaked white paper from a London-based fintech consultancy applying a settlement speed-to-value ratio framework to XRP's confirmed transaction infrastructure. The math is specific and verifiable. At XRP's documented 3.4-second average settlement time, the XRPL requires a minimum token price of $4.62 to handle the projected daily volume flowing through elite institutional payment corridors without generating liquidity fractures that would degrade the settlement cost advantage over competing infrastructure. Below $4.62, the settlement velocity advantage that makes XRP superior to SWIFT for high-value corridor transactions begins to erode under the weight of the transaction volume the infrastructure is being designed to carry. The current price is not the market's assessment of XRP's settlement value at institutional scale. It is an algorithmic suppression sustained by the supply that is currently sitting on public exchange order books, supply that is being systematically removed at a velocity that the Monday open will make impossible to ignore. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.